right, that was not the close to the week that we really wanted to see. The stock market ended up being pretty down. Russell 2000 down quite a bit, but the S&P ended up down almost 2%, 1.75%. Started off yesterday with some bearish news from Walmart and the banking sector, especially the big banks there. But today ended up being United Healthcare with some bad news coming from the Department of Justice. And it just kind of spiraled and it went south in the middle of the day. A lot of it due to kind of this higher inflation expectation environment that we've been in, that we got another confirmation of, another indicator of today, and then combine that with a lower economic activity environment, which we also got an indication of today as well. So those two things together is not something the market likes, especially in a regulatory environment that hasn't been so far as lax as maybe the market would have thought, considering, again, past precedent of the current administration back when they were first elected in late 2016 going into 2017. So all of that's put a lot of damper on risk appetite today, and as a result, yields are falling, but not in a good way, and we'll talk about what that means. Sector rotation is very poor. We'll look at that. And then a lot of indicators really turned south and gave us some indications that today might not be a one-off. So we'll break all that down. Taking a look at a trade, similar to other trades we've done. In fact, the write-up I did for the trade is very similar to what yesterday's trade was. So we'll break all that down, and along with that trade idea at the end of the video. So let's go ahead and get started. Today is Friday, February the 21st, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. If you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live videos, where I take a look at old Market Outlook trades, see whether we should stay in them or get out of them. We also put on today's trade already before the market closed. We do that here. You can also get to that here by clicking on Live Trade Review under the Market Outlook category. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. If you click this thumbs up icon, it opens up here, this tab. Click this like button. Again, the more you do that, it helps boost our posts, right? Kind of in an organic way. That's why we always ask. So thank you very much for those who do that day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's go ahead and start off taking a look at the S&P 500 with the market forecast indicators. You can see we finished down. We are down here, 1.7%. We ended up with a yellow line. We ended up closing below the 30-day moving average. As a result, we ended up with an intermediate confirmation signal, an oversold intermediate line, or excuse me, an oversold momentum line combined with a strongly bullish intermediate line. The difference, so technically, like and a near-term line in bearish territory. Technically, that's not that would actually be very bullish, or very, very bullish if we had that kind of pattern. The difference is the thing that lowers the probabilities of a bounce. We could still very well get a bounce. This is kind of a bull tag, but not really because we don't have the light pink shading. But this pattern would suggest a bounce. The only thing that would lower those expectations a little bit, or some, would be the fact that the momentum line is extreme. Usually the momentum line doesn't hit these extremes until we're at the end of these runs, right? Now sometimes, again, like this, we can bounce right off of that after that. But generally speaking, once you start getting extremes in the momentum line, then that, like this one for example, then we end up with an intermediate decline. So that's a little worrisome, especially when this is the first day that we've crossed below 60 on the near-term line. So we crossed below 60, 50, and 40 with the momentum line lower than the near-term line. That happens to be extreme lows, which means that on Monday, most likely that near-term line is going to follow suit and fall into the reverse. Unless we really bounce up high on Monday, that near-term line is going to follow down into the reversal zone and be pretty bearish. And again, we typically don't have bearish near-term lines, oversold near-term, unless we are, getting some dark pink shading and a red line potentially. We start to really get in. When we're bullish, we just don't get that. Get that low of a near-term line. So that's what would make me pause a little bit about the potential for this to bounce. I think it's actually unlikely that it will bounce yet. So 1.7% drop there, 2% decline on the NASDAQ 100. Very similar pattern, just did not finish below the moving average, but the idea is the same. We crossed below 60, we crossed below 50 and 40 all today at the same time. Extremely oversold momentum line. Looking very similar. Not surprisingly, these two indexes are pretty much mirror images of each other. Now, when I look at the Dow Jones, it's a little different story because the Dow Jones has United Healthcare in it and Walmart in it. Those last 2 days have been bad for those two companies. Also has J.P. Morgan and Goldman Sachs in it. So this one's been hammered here the last couple of days, and today getting a bull tag no less. And this bull tag actually again has a very bearish short-term sentiment, and not an intermediate confirmation signal because we're not strongly bullish anymore. We're weakly bearish there. And you're 1.5% below the moving average, which suggests, again, this could bounce. Bull tags tend to bounce, but they tend to bounce when we're not as far below the moving average. If you follow my cursor all the way to the left, this is pretty deep below the moving average for a bull tag. Again, we can bounce. Some of these bounced here that we ultimately got pretty deeply below too. But for the first day, for the actual tag day, this is a pretty deep level. So again, lowers the probabilities that we're going to bounce and more likely will build on this because remember, bearish runs also start. Not only do we bounce off bull tags, but bearish runs also start with bull tags. And I think that they're more likely to start an intermediate decline right now with this bull tag than we are to bounce. Finally, we'll take a look at the Russell 2000. And this also looks very bearish, right? It's already red. We went from green to red. We were red yesterday. We're now even more red today because we're 3.5% below the moving average. That's a deep, deep level. The short-term sentiment is very bearish. The near-term line is already in the reversal zone. The momentum line is at extreme lows. The intermediate line is almost out of bullish territory itself. So things have dramatically shifted on the Russell 2000. It's close to this closing low point that we had over here. So again, another reason why I think that the S&P is probably on pace itself for an intermediate decline right now. If I take a look at the weekly chart for the S&P, we had a higher high, we had a higher Hakunashi close. We ended up with a lower Hakunashi close, ever so slightly lower by 0.2 points, but still ended up being lower, and we have a lower shadow. And again, next week's candle is going to start at 60.57, right? The midpoint of this candle will be the open of next week's candle, right around 60.58, 57. We're trading at 60.13. So next week's candle is going to start off bearish. It might not end up bearish as we saw here, but because this one started off pretty darn bullish with a higher Hakunashi close, but it ended up turning into a transition candle, and the transition candle ended up being a relatively bearish candle, which suggests that we might end up with a bearish candle. I would expect, based off of that we'll end up with a bearish candle next week. This is what the market forecast candle looked like on the weekly chart. Again, you can see just how bearish. Sorry about that. Just how bearish the momentum line is. Barely below the 5th percentile, but still barely below the 5th percentile is still extreme because barely above the 5th percentile is pretty darn close to extreme. So it's a pretty extreme lows for that momentum line. Again, suggesting the higher probability that near-term line is going to drop below 60 next week. The question will be whether it also drops below 50 and or 40 with the momentum line down here, which would suggest weakness coming up here. So pretty bearish candle from that perspective. If I take a look at the Hull moving average, which is the other weekly candle that we like to look at, the daily Hull is below the 20 and 200 day hulls there. But if I look at the weekly version of this, again with that candle that ended up being a transition candle, but you can see we're already below. We've been converging here. We're already below. We'll see, we're still above the parabolic star. We're still above the 200-week moving average, but you can see the size of the candles here are declining. It's not looking as good it's looking more and more like we're going to be transitioning here and ending this mature bullish run that pretty much started at the end of 2022 going into the beginning of 2023. Again, not next week, but sooner rather than later, within the next so many weeks, potentially. If I take a look now at the 3 green arrow chart, obviously we have 3 red arrows here. Or excuse me, 2 red arrows, almost 3. A big jump in volume today, which is also not surprising. A big jump in that's a huge daily range as well. If I look at the weekly version of this chart, again, you can see that we got 1 red arrow on the MACD because we're in this convergence mode, because we're still above moving averages. But again, the stochastics is pretty strong. We're still above. We just don't have the dark green shading. We've been no shading for a long time going on here. And again, that tends to happen as you get to the end of these mature runs. You just get long periods of no shading before it finally turns pink there. So if I take a look at the 2-line version of this chart, you can see we broke below multiple moving averages today. The 8, the 17, and the 30, and we're that close to breaking the 50. The MACD has crossed below its moving average. The stochastics, albeit high, has also crossed below its moving average. Big change, right? If you look at IWM, you can see we broke below we're flirting with the 200-day moving average, and the MACD is negative stochastic. So I mean that's a huge distinction for the Russell 2000, because remember, pullbacks start when you break the 50. We've been on this pullback for a long time on the Russell. Corrections start when we hit the 200-day and bounce. Corrections start when you fail to bounce back up to new highs and you break the 200-day. That's when the corrections start, and that might be where we're at right now on the Russell 2000. As you can see on the weekly chart here, we are close to breaking below the 50-week and working our way down to the 200-week, which is again what corrections are, with the MACD on the weekly chart turning negative, and the stochastics already in bearish levels itself. If I take a look at some of these other oscillators, we were finally above 30, below 20 or below 25 on the positive indicator, with that ADX way down there. Again, set up for some kind of breakout move, and it looks like right now on the case of IWM, it's a breakout move to the downside, a pretty significant breakout move to the downside. Sorry. If I take a look here at the RSI and the CCI, so we have now broken below 50 on the RSI. That doesn't turn it red, but it does stop it from being green. So if I were to turn this to 220, so now it's done being green. Unless we can turn back up above 50, we're back. We're stopped. We're not green anymore, and it will turn red if we ultimately drop below 40 on this move. Below, and we're below 0, but we're not below 100, and we're definitely not below minus 100, which is what stops it from being green down there on the CCI. We're still above 0 on the weekly chart, so we're just fine there. If I take a look at the Ichimoku cloud, we are below the green and the blue lines. We had a weak trend. Remember I told you about these acting as resistance levels? Well, they did. Now we have no trend, right? Because we're below 1, we're below 50. We have no trend, and we are very susceptible to that red line crossing through and end up with a negative rate of change. Again, that's typical of declines. And then finally, we went from the highest quartile of the bandwidth and being above the bandwidth, but then being the highest quartile of the bandwidth yesterday to being in the lowest quartile of the bandwidth today. And the momentum has turned south. The bands are still inside of the Keltner channels. So we are clearly changing directions here. If I take a look at the intraday chart, we broke the lower half of the chart. We're not anywhere near a new high anymore. I told you before that the low range is setting us up for a squeeze play, and we were kind of hoping in these couple of days that it would be a squeeze to the upside, a breakout move to the upside, but it's now looking a little bit like a fake out move, as your stochastics here is way down, right? Close to, in fact, it's slightly into bearish territory, well below the moving average. The Russell 2000 is even worse, right? It's actually down near the lowest of the 4 weeks. Did get a new 4-week low point today. The moving average is falling. Very, very not looking good whatsoever. If I take a look at today's range, I told you already today's range was huge, way bigger than the average. The volume was well more than 1.5 times, so it's turning these lines back up above 1%. It's not what we want. It's turning the average back up. It's not the kind of move that we want. We like the slow grinding moves, not these big moves, which, we've talked about the skew being high and the volatility the VIX 3M being high because of how low the VIX was, flirting with this 85% mark and even lower at times, and flirting with 15. Well, we're not flirting with 15 anymore, nor are we flirting. In fact, we got above the 95% mark, which is bearish levels for risk appetite briefly before ending the day. And the VVIX jumped well above 100 today, up to 105. So it's not the way we wanted to end the week, not at all the way we wanted to end the week. And it's setting us up for what might be, Mondays typically aren't very good either this calendar year, so far at least. And it's setting us up for that type of start to next week as well. So something to pay close attention to as we head into NVIDIA earnings is how the market's doing here. I mentioned the skew kind of being a precursor to this. Well, if I look at the skew, remember how I told you it hit an all-time high just a couple of days ago when we were at all-time highs in the S&P. We are still at 175 today. We're actually at 178. I showed in my class today, when you look at the 200-day moving average of the skew, it's sitting at 153. Like, this is, just for some context, let's go all the way back on the skew, as far back as we can. So we'll go back to 1990 on this. Like look how high the skew is. That it typically gets high. Like, we're bullish when we're above the average, right? So we're bullish when we're above the average. We get bearish, in this case, correction level bearish when we get below the average. The average is at extreme highs itself, the 200-day average. If we were to start to get below this, like all these other instances, again, last time we got below it, it was close to being extremes, and we had a 20% correction, right? A lot of people thought that was so bad it was a bear market, but it was actually just a correction. Never broke the 200-week moving average, right? Here, it's even more dramatically worse. So, again, it would take a big drop, and obviously we're not there today and probably won't be anytime soon, but that kind of gives you an idea. Like, the market has been anticipating days like today with how high the skew is, so it's not surprising when we do get them. And as I showed my class here today as well, today ended up being a 1% decline, 1.7% decline here. But if you look, so it change this to 1.71. But if you look, this isn't the only 1.71 drop that we've had. We've had multiple of that kind of drop or more. And if I were to go back to the beginning of 2023, right? Because, remember 2023, 2024 were both 20% gains to the upside. And then, we've had we're still positive slightly this calendar year. We've had plenty of 1% or more declines, plenty of them throughout these years. So just because we got one today doesn't mean the world's going to end. But a lot of these signs suggest we're at least now more than likely headed on this current decline towards an intermediate pullback that gets us a red tag. Finally, because we didn't get one over here and ended up only being 4.3%, but finally getting a red tag of at least 5%. And if that's all it is, fine. If it ends up being something more than that, like it was here in early 2022, if it's this kind of bear tag, we're fine for another green tag. If it's this kind of bear tag, then the next green tag most likely will be a failure. And then that would tell us that we're in correction mode at that point. So we'll kind of keep our eyes on that, especially considering, again, what's driving the price action here today. All right, let's talk about now what's driving this price action here today. As you can see, gold is still obviously the biggest driver, and everything else is pointed lower except for bonds to the upside, and gold is flat. So if I were to zoom in on today alone, all right, let's see here. I think I had it there. Let's try again. All right, so bonds are up the most, which means yields are down quite a bit, and that's what we'll talk about that some more in a second. The dollar is up today, and then gold isn't necessarily up, but it's outperforming equities to a large degree, U.S. equities, to the downside. In fact, if I were to come over here to the ratio chart, as you can see, yields are down. We'll come back to that in a second as well. But if I were to look at the ratio chart here of gold to the stock market, it's been rising, right? And you think, oh man, this is like, there's only a 1 year chart. So let's go to like a 5-year chart. And this tells a little different story, right? Like there's all these peaks that we get. And we don't know if this is the peak, right? It's a pretty parabolic move right now. The CCI has been bullish for a while. The MACD is pretty high. The RSI is up there above 70. The ADX got above 50, or the positive indicator, excuse me, got above 50. The ADX still hasn't really risen too high, but still is a pretty parabolic move here to get to this point. But you also notice that gold really dropped in 2021 during this inflationary period relative to equity. Equities way outperformed gold during that. And again, this isn't the first time that gold has really taken off. Even, like, remember, the stock market has been bullish these last 2 calendar years, 20+%. There's been plenty of times where gold has just destroyed stocks during that time frame, even though stocks are up 20%. And even though this ratio is negative with, it's got a negative correlation with the market, which means that when gold is outperforming, usually that's bearish for equities, not bullish for equities. This is like the last 3 instances have been instances where they've been positive correlations, right? So right here has been positive, here was positive, and here's positive. So in all 3 of these last instances where gold has outperformed equities, the correlation has been positive, slightly positive with the S&P, which means the S&P has been bullish during these time frames. So kind of interesting development here, but again, it is and the MACD is relatively high, not as strong as some of these others peaks have been. So there still is some opportunity for this to continue to move higher. But TLT has been severely underperforming equities for so long. And if you take a look at that one here, TLT relative to the S&P 500, again, this is a significant breakout above the 50-day average that we've seen. This is the first one that we've seen in a while, multiple months. If I zoom in here, I mean, look at that. That's a significant breakout on bonds, again, relative to the S&P. We saw this here in August where we had that kind of parabolic run, and again in September, but those are significant lows that they were just kind of like out of nowhere moves. This is not really an out of nowhere move. Like, it's been gradually moving up. We based here in January. We've been gradually moving higher, and then today now breaking out, right? Breaking out again on a relative basis relative to equities. So, can things be changing here to where, like, now bonds are outperforming equities? Well, that, again, this ratio is generally negative. It's positive right now, or it's actually 0 right now, but generally speaking, you can see for the most part is negative correlate. When bonds are outperforming equities, equities are generally not rising. There was a period of time where they both rose, or they both fell, excuse me, here in 2023 briefly during that fall, right? That fall there, they both kind of fell. But generally speaking, when bonds are outperforming equities, that's because they are both falling. Because remember, they both tend to move in the same direction when we're in an inflationary environment, which is what we're in. The correlation right now with bonds to equities is still, take a look at bonds here. It's been largely positive. Let me zoom out so we can get a better picture here, if it will let me. There we go. So there we go. So let's go out to a 3-month correlation, a little bit longer periods, less volatile. And you can see we're back to a positive correlation over the last 3 months of equities to bonds. So when they tend to both move in the same direction, obviously not today, but when they both move in the same direction, we're in an inflationary environment. Again, not on a day-to-day basis, but on a some kind of time frame basis there. And obviously when when they're both falling, when the correlation is negative, we're in a deflationary environment, which it can either be positive, equities are up, bonds are down, which means yields are rising, or bonds are up and equities are down, which means yields are falling along with equities. And that's, again, that's the typical, when people say deflation, they consider stocks falling, but there's been the last couple of decades we're in a deflationary environment for yields. It's been falling since the early 80s all the way to the low point with COVID, post-COVID. And there was a lot of really good, strong bull markets within those multiple decades there. So you can be in a deflationary environment and still be bullish for equities. But still, so that's kind of when the correlation, but right now the correlation is positive. The inflation expectations came out today and they were pretty strong. So the market is in an inflationary environment right now, and And so that's kind of what we're seeing, despite the fact that bonds rallied today and equities didn't. That's kind of the atypical. That's not the norm for the kind of move that we're seeing. Let me go back to the asset class comparison. The other thing that I wanted to take a look at. So we have the move in yields, which is what is here. I mean, that's a clear break of the 50, the 8 and 17. Now, see, last time we broke the 50, the 8 and 17 weren't there, but now the 8 and 17 are breaking the 50. So we are low enough now, below the 50-day moving average, that we are pretty bearish here. That the 8 and 17-day moving averages are breaking the 50-day moving average. So that's pretty bearish for yields, right? So it means pretty good chance we probably move towards the 200-day moving average here, which, again, has been bullish for equities in the past when yields have been falling. But yields are falling right now because economic conditions are deteriorating, are not looking nearly as positive from what we're hearing from Walmart and even what we're seeing from the big banks, and United Healthcare to a degree here with the regulatory environment not being as conducive as maybe some investors thought it would be with the new administration. So the yields are falling. And probably not the best thing. In fact, I said we'd come back to this. What's really the worst is not the 10-year yield. If the 10-year yield falls but short-term rates stay the same, great. But you notice short-term rates are falling too. And that's like, if this continues to fall, it's already below the current range of 4.25%, 4.5% for the Fed funds rate. If this continues to fall further, then that suggests that the Fed, that the market is pricing in a Fed cut. And really, the first cut, the Fed's not going to cut in March. Sorry about that. The Fed's not going to cut in March. Fed will most likely not cut in May when they can't give projections and a dot plot and economic projections to go along with it, with their first move, right? Whether it's a hike or a cut. So most likely, the first cut would be in June. That's the earliest the Fed can cut. And that would be a bearish, that's a bearish scenario. If the Fed cuts in June, which now is looking increasingly more likely because we just went from a 50-50 proposition a week ago, last Friday, to now a 63%, 64% probability this Friday. So it's high. It's barely above 60, but still that's high probability range. So if the Fed cuts in June, that's the worst case scenario. That would mean that yields are falling. And again, we don't want yields to fall because economic conditions are deteriorating, because that impacts earnings. And as we saw, earnings are already declining in terms of their growth rate, right? They're still positive, but the growth rates are declining. And we've got stocks that are way too valued, way too highly valued for earnings to be starting to slow down, if not eventually turn negative, at least start to slow down. And that's why we're starting to see some weakness like we see here today. So biggest reason for today's decline, you can see TLT, dark green shading the green line. Good, strong, bullish short-term sentiment there, even if the momentum line isn't quite where we want it to be. On the other hand, the dollar, along with yields, bearish levels, right? Dark pink shading and a red line, and you can see the intermediate lines well in the reversal zone. No cluster today, but well in the reversal zone there. So not the pattern we want to see. Usually it is like the falling yields is great. But again, it's the reason why they're falling. Like before, it was great because inflation levels were falling, but inflation levels aren't falling. They're actually higher. We saw that today with inflation expectations being higher, and economic conditions are deteriorating. Again, not like they're like in the trash right now, but they're worsening from the pretty decent levels where they were at. Instead of improving even more, they're worsening. And the economic surprise index, which is kind of a reflection of that, the economic surprise index here, right here, it has gone negative, right? So this takes a look at our economic indicators, how they're doing relative to estimates, and now it's gone negative. And the yields kind of follow the trend of this particular index. So, and again, we don't want the yields to fall because of this is falling. We want yields to fall because inflation expectations are falling, and of course, they're not falling, as you can see now. The nowcast hasn't been updated for January because we got to get through the PCE release here. But as of right now, that's still a pretty decent number. And we're still hovering around 3%, stubbornly hovering around 3%, whereas previously this number was closer to 2.5% for February. Now it's increased over the January release and now up to 2.8%. So the inflation expectations are not on the decline. Breadth has not looked good today. Today was the worst breadth that we've seen. Not surprising considering the decline. The worst breadth that we've seen here. Sorry, let's get to the breadth indicators. So breadth is bad. You can see the McClellan oscillator back to, and it's not below minus 35, but it's down. And the other thing too is that our sector comparison, you can see all of our cyclical sectors today really on the outside of Apple, really all of our cyclical sectors on the decline. XLK, XLY, not so bad on XLC, but those two in particular, big declines, along with materials, energy, and industrials, which are economic growth sensitive areas. Financials not doing as badly because they had a big loss yesterday already. And you can see our safety trades. In fact, you know, I shared this with you, I think, in yesterday's market outlook. But, you know, it's not necessarily a positive development when your safety sectors are the ones in the leading category. XLK is there, but all the other cyclical areas are moving down to the left, including XLC and XLY. So, and XLE is improving, which again, when XLE is outperforming, generally the market's not bullish. So this is not the, outside of XLK doing so well, this is not the pattern really that we want to see from a sector rotation standpoint. All right, for our trade idea today, I want to take a look at Delta Airlines. You notice Delta Airlines is showing a bearish pattern on its market forecast chart, dark pink shading, a red line, closing below a lot of lows, filling in the rest of this post-earnings gap that it had here. Intermediate line had already crossed below market sentiment. Bearish short-term sentiment had already been, a bearish near-term peak, has already been developed. Now we're rolling back over. We're crossing below the 50th percentile on the intermediate line. Bearish short-term sentiment here, even though we're off the low slightly down there, about 9.5% below, which is not, you know, it's low, but it's not in the lowest decile yet. We're still in the 18th percentile. So, you know, beginning stages potentially of a bearish decline, especially when you look at some of these other indicators. The weekly chart, you notice is we had a little bit of a divergence here, lower highs with these higher highs. Bearish candle with a red arrow means we're crossing below the moving average. Pretty decent sized body, bigger than any of these that we had. You know, you can see going back, it's a pretty decently sized body there for the beginnings of a of a bearish move. At least these to be of the early stages of a bearish move. And we don't know if it's the beginnings or not, but we do know it's early because it just barely turned bearish. If you take a look at the 3 green arrow chart, we obviously have 3 green arrows on the stock, or 3 red arrows, excuse me, on the stock. Now with a red line, with that drop there. If you take a look at the 2-line version of this chart, you can see we're well into the gap between the 50 and 200-day moving averages, into the gap of volume as well. So we're really moving lower. If you take a look at the let's see some of these other oscillators. So let's take a look at the DMI. You'll notice that it's a bearish pattern here. We crossed above 30 on the negative indicator, below 20 on the positive. That's not necessarily, that's a breakout pattern for that. The RSI and the CCI look very similar. The RSI has dropped below 40 for the first time. Didn't do that at all over here. For the first time since over here, the very bearish short-term sentiment there. In fact, or CCI, excuse me. In fact, we're dropping below 6 or 0, well below 0. Potentially dropping below 100 next week, depending upon where how we open. Sorry about that. If we take a look at the Ichimoku cloud for Delta, you can see we are below the cloud, negative rate of change. We have an intermediate strength trend. We're right at the -2 mark. They're kind of flirting with -2, right at 65 as well. So the beginning of an intermediate strength trend. And then finally looking at your Bollinger Bands and the Keltner channels, we actually closed below the lower band today. The bandwidth is rising. We closed below the lower band and the lower Keltner channel. And the bands themselves are maybe a day away from crossing outside the Keltner channels as well. So very, very bearish breakout move on Delta. So what I decided to do here during the Market Outlook Live, remember we've already done this trade. We did it in the Market Outlook Live session. But we did a long put vertical spread, sold the low 20 Delta, bought this next strike away. So this is what it looks like here. Just go single symbol. So position sizing for directional trade, which we usually do around $500, giving us about a 2-to-1 reward to risk ratio with plenty of flexibility. We're already up a little bit on the trade. Let's see here, where are we at on the trade? We are Delta Airlines right up here. So already slightly positive. Everything else that we haven't closed, right? We've closed some trades on various market outlook live sessions, but everything that we've kept so far has got pretty decent returns. Some of these are February, like these all down here are all February expirations, not AbbVie, but the rest of these are all February. So these are all some pretty good gains that will come off the table. But we also have a pretty good start to March as well. So that's the benefit, again, of watching the Market Outlook live trades, is not only do we put the trade on already before the market closed, so you don't have to wait till the next day, but we also review old trades to see whether we should stay in them or get out of them. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember, subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Friday and weekend, everybody, and we will see you all on Monday.